Preparing for a financial analyst at GEICO interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a financial analyst at GEICO? GEICO appeals to me because it combines a recognizable consumer brand with a highly analytical insurance model. I want to use financial analysis to understand premium growth, claims trends, operating expenses, and customer economics, then translate those findings into practical recommendations. GEICO's scale would also let me work with meaningful datasets and see how decisions affect profitability. I would bring strong Excel skills, attention to detail, and a willingness to learn insurance-specific metrics quickly. While answering, connect your analytical strengths to GEICO's insurance business, emphasize interest in pricing, claims, profitability, and customer value, and demonstrate that you understand the importance of disciplined decision-making in a high-volume operating environment. Question 2. What do you know about GEICO's business model? GEICO primarily writes personal auto insurance and is known for a direct-to-consumer distribution model supported by digital channels, advertising, and centralized operations. It collects premiums, pays covered claims and expenses, and invests available funds until they are needed. Financial performance depends on both underwriting results and investment income. The critical balance is growing policies and premiums while pricing risk adequately, controlling acquisition costs, managing claims inflation, and maintaining strong customer service. Make sure to cover GEICO's focus on personal auto insurance, direct-to-consumer distribution, premium collection, claims payment, underwriting profitability, investment income, and the relationship between scale, pricing, risk selection, and operating efficiency. Question 3. How would you analyze GEICO's revenue performance? I would begin by reconciling written premiums to earned premiums, because revenue recognition follows coverage provided rather than billing alone. Then I would decompose the change into policy growth, average premium, rate actions, retention, new business, cancellations, and geographic or vehicle mix. I would compare actuals with budget and prior periods, investigate unusual movements, and assess whether growth reflects healthy pricing or merely greater exposure. That analysis connects revenue directly to future claims and profitability. In your answer, discuss earned versus written premiums, policy count, average premium, retention, new business, cancellations, geographic mix, rate changes, exposure growth, and separating volume, price, and mix effects. Question 4. What is the difference between written premium and earned premium? Written premium is the premium associated with policies issued or renewed during a period, while earned premium is the portion attributable to coverage that has already been provided. For example, if a 6-month policy is written today, the premium is generally earned over those 6 months rather than immediately. Unearned premium remains a liability until coverage occurs. Written premium shows sales momentum, whereas earned premium better matches the claims and expenses generated by current coverage. Be sure to mention that written premium reflects policies issued or renewed, while earned premium reflects coverage expired over time. Explain deferred revenue, seasonality, growth effects, and why analysts monitor both measures. Question 5. How would you explain the combined ratio to a non-finance manager? The combined ratio measures underwriting costs as a percentage of earned premium. It usually combines the loss ratio, including claims and related loss adjustment expenses, with the expense ratio. A ratio below 100% means underwriting is profitable before investment income. Above 100% means premiums did not cover claims and expenses. I would explain that investment returns can still support total profitability, but the combined ratio isolates whether the insurance operation itself is priced and managed effectively. Focus on the formula, loss and expense components, interpretation below or above 100%, distinction from investment income, and why management uses the metric to evaluate underwriting performance. Question 6. What factors can cause GEICO's loss ratio to increase? A higher loss ratio can result from more claims, larger claims, or premiums that have not kept pace with risk. I would examine mileage, vehicle mix, geography, weather events, theft, repair and medical inflation, litigation, and changes in driving behavior. I would also separate current accident year deterioration from prior period reserve development. Finally, I would compare trends with pricing actions and exposure changes to determine whether the issue is temporary volatility or evidence that rates and underwriting need adjustment. Make sure to cover claim frequency, severity, repair costs, medical inflation, litigation, weather, theft, driving behavior, mix changes, inadequate pricing, reserve development, and the importance of distinguishing temporary from structural pressure. Question 7. How would you build a monthly forecast for an auto insurance business? I would build the forecast from operational drivers rather than simply applying a growth percentage. Policy counts, retention, new business, average premium, rate changes, and earning patterns would drive premium. Claims would be forecast using exposure, frequency, severity, and development assumptions, while expenses would reflect staffing, advertising, technology, and inflation. I would include investment income separately, model base and downside cases, and compare monthly actuals with forecast to refine assumptions and explain variances. In your answer, describe policy and premium drivers, earned premium timing, claim frequency and severity, expense assumptions, investment income, seasonality, scenario analysis, and variance reviews that update assumptions continuously. Question 8. Tell me about a time you found an error in financial data. In a reporting project, I noticed that a monthly expense trend was unusually high compared with both budget and the prior year. I reconciled the report to the general ledger and found that one invoice batch had been loaded twice. I documented the duplicate entries, confirmed the issue with the accounting team, corrected the report, and quantified the impact for management. I then added a duplicate check step to the process, reducing the chance of recurrence. Be sure to structure the response with situation, investigation, root cause, correction, communication, and prevention. Emphasize skepticism, reconciliation, documentation, and avoiding blame while protecting reporting accuracy. Question 9. How would you analyze a budget to actual variance in claims expense? I would first confirm that actual and budget figures use consistent definitions and periods. Then I would decompose the variance into exposure volume, claim frequency, average severity, policy mix, catastrophe activity, payment timing, and reserve changes. I would compare accident year and calendar year views to avoid confusing current claims with prior development. After validating the drivers with claims or actuarial partners, I would quantify each contributor and recommend whether the forecast, pricing assumptions, or operating plan should change. Discuss decomposing the variance into volume, frequency, severity, timing, mix, reserve changes, and rate effects. Explain validating data, collaborating with claims teams, and presenting an actionable conclusion. Question 10. What is loss reserving, and why is it important to GEICO? Loss reserving is the process of estimating the ultimate cost of claims that have occurred but are not fully paid. The estimate includes reported claims still developing and incurred but not reported claims. It is important because reserves affect liabilities, earnings, capital, and pricing decisions. I would rely on actuarial analyses, historical development patterns, current claim trends, and management judgment, while monitoring reserve development over time. Under-reserving can overstate earnings today and create painful adjustments later. While answering, explain estimates for incurred but unpaid claims, reported and incurred but not reported losses, uncertainty, actuarial input, reserve development, financial statement impact, and the consequences of underestimating obligations. Question 11. How would you evaluate whether an insurance product is profitable? I would evaluate profitability by comparing earned premium with expected claims, claim handling costs, acquisition expenses, servicing costs, and allocated overhead. The combined ratio provides the core underwriting view, but I would also consider investment income, required capital, retention, lifetime value, and profitability by state, vehicle, customer cohort, or coverage type. A product may appear attractive on average while hiding unprofitable segments, so I would examine mix and risk-adjusted returns before recommending growth. Make sure to cover earned premium, loss ratio, expense ratio, combined ratio, acquisition and servicing costs, investment contribution, customer retention, segmentation, capital requirements, and profitability by cohort or geography. Question 12. What Excel tools would you use in a GEICO financial analysis role? I would use pivot tables and SUMIFs to summarize premiums, policies, claims, and expenses by period or segment. XLOOKUP or index match would support controlled mapping between source files, while logical checks would flag missing or inconsistent records. For forecasting, I would build driver-based schedules with sensitivity tables and clear assumption cells. I also use charts to communicate trends and reconcile totals back to source systems. When datasets become larger, Power Query can improve repeatability and reduce manual errors. Mention pivot tables, XLOOKUP or index match, SUMIFs, logical formulas, charts, data validation, scenario analysis, reconciliation checks, Power Query if relevant, and clear documentation of assumptions and outputs. Question 13. How would you assess the financial impact of a proposed rate increase? I would estimate the direct premium impact, then model customer response, including retention, shopping, cancellations, and new business conversion. I would compare the proposed rate with loss cost trends, competitor positioning, and regulatory requirements by state. The analysis should show effects on earned premium, exposure, loss ratio, expense ratio, and lifetime value, not just the first-year revenue increase. I would present base, upside, and downside scenarios because the financial outcome depends heavily on elasticity and mix. In your answer, address premium uplift, elasticity, retention, new business, competitive response, regulatory approval, exposure changes, loss trends, profitability by segment, and sensitivity analysis around customer behavior. Question 14. How do investment results affect an insurer's financial performance? Insurers receive premiums before many claims are paid, creating investable funds often called float. Investment income from that portfolio can supplement underwriting income and improve total profitability. However, assets must be managed with liquidity, duration, credit, and regulatory constraints in mind so they support future claim payments. Higher rates may increase recurring income, while market losses can affect earnings or capital depending on the assets. I would still evaluate underwriting independently rather than using investment gains to justify inadequate pricing. Be sure to distinguish underwriting income from investment income, explain float and asset liability matching, discuss interest rates and market movements, and note that investment results should not mask weak underwriting discipline. Question 15. How would you investigate a sudden decline in policy retention? I would first verify the retention definition, cohort period, and data completeness. Then I would segment the decline by state, tenure, renewal month, product, price change, channel, customer risk, and claims experience. I would review cancellation reasons, contact center feedback, billing issues, competitive pricing, and service metrics. After identifying the strongest drivers, I would estimate the financial impact and test targeted actions, such as communication or pricing changes, using retention and profitability measures rather than retention alone. Focus on validating the data, segmenting cancellations, identifying price and service drivers, examining competitors, claims experiences, billing issues, channel mix, and testing corrective actions through measurable cohorts. Question 16. Describe a financial model you have built and how you ensured it was reliable. I built a model that forecast monthly revenue and expenses for a student organization using membership, pricing, event volume, and staffing assumptions. I separated inputs, calculations, and outputs so changes were easy to trace. I reconciled the starting point to historical results, added balance and reasonableness checks, and tested optimistic and downside cases. Before presenting it, I had another person review the formulas and documented limitations. That process made the model more transparent and useful for decisions. Mention model purpose, inputs, calculations, outputs, assumptions, independent checks, historical backtesting, sensitivity analysis, version control, and explaining limitations clearly to stakeholders. Question 17. How would you communicate a complex financial finding to a non-finance leader? I would start with the decision-relevant conclusion, such as, claims costs are running above plan primarily because repair severity increased. Then I would quantify the impact, show 2 or 3 supporting drivers, and explain what is controllable versus external. I would avoid unexplained insurance terminology and use a simple chart or bridge where helpful. Finally, I would recommend an action, identify the key uncertainty, and invite questions so the discussion stays focused on business implications. In your answer, emphasize leading with the conclusion, using plain language, quantifying business impact, showing the main drivers visually, avoiding unnecessary technical detail, and offering a clear recommendation or decision requested. Question 18. What would you do if a senior stakeholder challenged your variance analysis? I would first listen carefully and clarify which assumption or result the stakeholder questioned. I would revisit the source data, definitions, formulas, and time period rather than defending the conclusion automatically. If I found an error, I would correct it promptly and explain the change. If the analysis remained sound, I would show the supporting evidence and acknowledge reasonable uncertainty. My goal would be a credible decision, not winning an argument, while documenting any agreed follow-up work. Be sure to show professionalism, listening, evidence-based reasoning, willingness to revisit assumptions, transparent documentation, escalation when necessary, and separating factual disagreement from interpretation or judgment. Question 19. How would you prioritize multiple urgent requests from different teams? I would rank requests by business impact, deadline, dependency, and risk, giving priority to items tied to financial close, regulatory reporting, or major operating decisions. I would estimate effort, identify quick wins, and communicate a realistic delivery sequence to each stakeholder. If 2 priorities conflicted, I would escalate the trade-off early rather than miss both silently. A simple tracker with owners, status, assumptions, and next steps would help me maintain accuracy while moving quickly. Discuss business impact, deadlines, dependencies, regulatory or close cycle importance, effort required, stakeholder communication, transparent trade-offs, and using a tracker to maintain control over competing deliverables. Question 20. What questions would you ask before accepting a financial analyst assignment at GEICO? I would ask how the team supports GEICO's major decisions and which metrics define success in the role. I would want to understand the balance between recurring reporting, forecasting, ad hoc analysis, and process improvement, along with the systems and data sources involved. I would also ask about collaboration with underwriting, claims, actuarial, accounting, and operations teams. Finally, I would ask what strong performance looks like after 6 and 12 months and how analysts receive feedback. Ask about team structure, core responsibilities, reporting cadence, systems, key performance indicators, training, stakeholder exposure, success measures, and how analysts contribute to underwriting, claims, or strategic decisions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.